Welcome, market participants, to another Three Things in Credit. I'm Van Hester, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So we tuned in this week to an interview David Rubenstein conducted with Charlie Scharf, CEO of Wells Fargo. Fresh off of solid earnings, Mr. Scharf was upbeat, as you would expect a bank CEO to be, in a relatively healthy economy and benign credit environment. But Mr. Scharf was more than a little upbeat, especially given the noisy and varied macro backdrop. He described the economy as, quote, extremely strong, unquote, with consumer spending growing by 5 to 7% annually, loan demand decent, and consumer delinquencies extremely well controlled. Businesses, he added, are in strong financial shape. But then he added this, but everyone's nervous. That stuck with us. How do nervous people behave? Something to ponder. This week, our three things are: 1. Earnings growth. One observer describes earning growth as soaring. Is that right? 2. Bank exposure to non-banks. Should we be worried about the linkage? And 3. Constructive pessimism. It's present and it's bondholder-friendly. All right, let's dig a bit deeper. Earnings growth. So stocks are soaring and credit spreads are tight. Underpinning both are strong corporate earnings growth. We've not had a so-called earnings recession, that's where back-to-back quarters show a year-over-year earnings contraction, since the first two quarters of 2023. And lately, earnings growth and expectations have clicked into overdrive. In 6 of the past 7 quarters, earnings growth has been double-digit, and that's the consensus expectation for the upcoming 7 quarters. That's as far as Bloomberg tracks estimates. Now, driving the growth is the increasingly large tech sector, benefiting from what is perceived to be a transformational tech revolution. Productivity gains, as well as the ripple effects that go with it, are expected to keep this train a-rollin'. This week, a headline in the New York Times caught our eye. Corporate profits are at record highs. These 4 factors could sink them. An opinion piece written by Peter Coy. Okay, then. Any good analyst instinctively knows to test conventional wisdom. Things, in this case corporate earnings, don't grow to the moon, even though at times we can get caught up in believing they do. So taking a contrarian's view is a path to any analyst's holy grail, calling the turn. What could sink earnings growth? Well, Mr. Coy has 4 factors. 1. Business concentration may not keep rising. Earnings growth has benefited from business consolidation and the pricing power and efficiency gains that go with it. Mr. Coy suggests there is a limit to how much more consolidation can take place. 2. Interest rates are not falling anymore. Ultra-low interest rates have clearly benefited corporate bottom lines, but cost of capital has corrected. 3. Fiscal policy will become less stimulative. All of the stimulus injected into the economy, most notably post the GFC and during COVID, have pushed debt to GDP to a level that puts the U.S. on the bond vigilante radar. And 4, the erosion of labor market regulation. Labor's share of profits is at a historic low. The pendulum swinging back somewhat is not out of the question. As Mr. Coy observes, there are lots of forces acting on profits, but one clear one is that profits this far above the historical norm tend to generate pushback. We agree. Usually that means excess profits fall for one of 2 reasons. Either they get competed away, or large corporate bureaucratic bloat eats away at them. And yes, it's hard to imagine that ultra-low interest rates will return anytime soon, nor will another round of corporate tax rate cuts be on the way. Both have contributed to extraordinary earnings growth over the longer term. All of this is worth taking into consideration. But how relevant are any of these things today? Over the near term, the earnings growth picture, not just for the Mag 7, but also for the S&P 493, the S&P 400 mid-caps, and the S&P 600 small-caps, figure to be more than sufficient to support elevated risk asset valuations. All right, on to our second thing. Bank exposure to non-banks. Anyone out there trying to develop a storyline that what's happening today in private credit is in some way reminiscent of what took place in the lead-up to the global financial crisis needs to believe that there is the possibility of contagion, a widespread questioning of asset values that spreads into markets and the banks. After all, the size of the riskier part of private credit, direct lending, is just not that significant at around 10% of corporate lending or 3% of total private sector borrowing. More than a few organizations, regulators, and supranational agencies have expressed concern about bank exposure to non-bank financial institutions, labeled either NDFIs, that's non-depository financial institutions, or NBFIs, that's non-bank financial institutions, or the more dramatic shadow banks. You pick your preferred choice. According to the Fed, banks are now in the business of providing liquidity to NBFIs in the form of lines of credit rather than just originating and holding term loans. Nothing controversial about that. Bank loans to non bank lenders and asset managers, where the majority of exposure lies today, are overwhelmingly senior secured, which makes the nature of risk held by banks very different today than what was the case prior to the GFC. We here at KBRA have long expressed a view that this concern misunderstood the nature of bank exposure to non-banks and how it has changed since the GFC. As we wrote recently, banks continue to participate in the recent rapid expansion of private markets in a mostly less risky format than would have occurred without the post-GFC regulations. Their exposure has been largely limited to senior secured positions in over-collateralized portfolios, such as secured credit facilities to funds or business development companies. KBRA views this as a significant net positive for the financial system. Now, the large banks in Q1 all took time to address market concerns about exposure to non-bank FIs. In the aggregate, the Big Four have approximately $670 billion in loans to non-banks, or about 15% of their total loans. Wells Fargo spent the most time on its earnings call addressing the issue. Its exposure to financial institutions except banks, there's another label for you, totaled $210 billion, a not insignificant 21% of its total loans. According to management, these loans are generally secured with advance rates that provide significant margins of protection against expected losses during periods of stress, and the lending structures often include structural protections should collateral performance deteriorate. And while you can debate just how stressful the current environment is, at March 31st, non-accrual loans in this sector at Wells represented 0.1% of total exposure. Its portfolio is made up of a broad mix of borrowers. Fund finance, mostly subscription lines, accounts for 36%. Traditional commercial finance is 30% of the total. Real estate finance, both commercial and residential facilities, represent 18% of total non-bank loans, and consumer finance, mostly auto, accounts for the balance at 16%. Traditional commercial finance is the yieldier, i.e., riskier, part of this business, and management's deck provides lots of detail defining the risk. 5 specialized units provide secured financing with advance rates at less than 60% up to 72%. Lending to BDCs is in here. That exposure totals $8.3 billion, or less than 1% of Wells' total loans. Software loans total $6.2 billion, or less than 1% of Wells' total loans. The total commercial finance portfolio represents less than 4% of Wells' total loans. Have a look at the 4 slides in Wells' deck. You'll develop a better understanding into the risk of this lending. And for those of us that have been around for decades watching risk-on lending evolve, bank lending to non-banks today does not flash red. All right, on to our third thing, constructive pessimism. So we've coined this phrase to describe what ultimately is an important element guiding risk takers, both commercial and consumer, that dampens volatility. We thought about this when reading the aforementioned New York Times piece on corporate profits. And thinking about the current streak of economic growth in the U.S., that's nearly 17 years if we take out the 2 months at the outset of COVID, the author quotes market observer Jim Paulson, who notes, the traditional preconditions for a downturn, overextended consumers, overleveraged businesses, excess staffing, are largely absent, Paulson said. Sure enough, if we think back really to the period in the immediate aftermath of the GFC through today, there has not been a moment of unbridled optimism and clear visibility. There was always something that curbed excessive risk-taking. The euro crisis in 2011, the downgrade of U.S. debt in 2011, the energy downdraft, China slowing, and the retail apocalypse in the mid-2000 teens. COVID, 40-year inflation, and the monetary tightening that followed. And now tariffs and geopolitical disruption. There was always something out there that weighed on risk takers' more reckless risk taking. As a result, that collective ongoing worry has kept consumers and businesses prudently cautious. Household and corporate balance sheets today are strong. Corporate profitability is high, as is investment in technology, yet non-farm payroll growth has dwindled to stall speed. Consumer spending has been buoyant, but as the savings rate slows and borrowing rises, we see consumer spending slowing, not hitting a wall, but slowing. Growth in leveraged finance is slowing. We see it in monetary policy. Worried about inflation, the Fed has hit pause. Constructive pessimism. It works for bondholders. So there you have it. 3 things in credit. 1, earnings growth. It's strong at the moment, but be aware of things that could slow that growth. 2, bank exposure to private credit. Actual risks in those portfolios are relatively low. And 3, constructive pessimism. It's present and it's bondholder friendly. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.